Welcome to Module 3, Market Analysis and Forecasting Fundamentals. By now, you have a solid understanding of technical analysis and supply and demand. But to complete the puzzle, we need to introduce one final piece, the driving forces behind major market moves, fundamentals. In this module, we will cover the introduction to fundamentals, commitment of traders, valuation, and also seasonality. Fundamentals shape the broader market landscape, influencing long-term trends and price movements. In this module, we will break down how fundamental factors impact supply and demand dynamics and show you how to integrate them into your trading strategy. Additionally, we'll introduce you to our proprietary indicators, powerful tools designed to help you analyze and anticipate market movements with greater precision. Let's get started. Module 3, Lesson 1, Introduction to Fundamentals. In this lesson, we take a step back and ask what really drives price. Understanding the forces behind market movements is essential for making informed trading decisions. To do this, we'll break down the 4 key questions that every trader must ask before entering a position. These questions will help you align your trades with market conditions, improve your probability of success, and ensure you're not just reacting to price, but truly understanding the reasons behind its movement. Let's talk about price for a moment. Have you ever wondered what actually drives price? You might think, well, price drives itself. But is that really true? Can that even work? Here's the thing. Price is an effect, not a cause. Price movements reflect underlying market dynamics, but they're not the source of those movements. When we focus only on price in isolation, we're just looking at the outcome, the tip of the iceberg, while ignoring the deeper forces that actually drive those movements. So what are these underlying forces? We call them fundamentals. They are the true drivers of market behavior. Fundamentals like supply and demand and market sentiment dictate price trends and shape the markets we trade in. Now here's the challenge. Fundamentals aren't visible on a chart. All we see is price. That's why we use our proprietary indicators to bring fundamentals to life on the price chart and making them easy to analyze and interpret. But here's the mistake most novice traders make. They ignore fundamentals entirely. They focus solely on price, leaving them blind to fundamental shifts that signal changes ahead of time. As a result, they're always reacting to the market instead of proactively positioning themselves for what's coming. Without understanding fundamentals, they're essentially trading in the dark. In the next section, we'll take a closer look at fundamentals, what they reveal about the markets, and how we can use them to sharpen our analysis. Fundamentals give us the ability to see beyond price and understand the deeper forces driving the markets. Here's what they can reveal. First, the positioning of all major market participants, both the professionals and the less experienced traders. Fundamentals like those found in the Commitment of Traders (COT) report show us who is behind the market's movements. Are the pros accumulating positions while the noobs are chasing momentum? These insights help us gauge where the market might be headed next. Second, recurring seasonal patterns. Fundamentals allow us to uncover predictable cycles in the market, patterns tied to the time of year or recurring events. These cycles have historically led to strong returns when properly identified and leveraged, giving us a chance to anticipate moves that follow these trends. Third, whether a financial asset is overvalued or undervalued. Fundamentals provide an objective measure of value, helping us recognize when an asset is mispriced. This perspective allows us to identify opportunities others may overlook and prepare for potential reversals or trends. And most importantly, fundamentals are forward-looking, while price is merely a reflection of the past. Fundamentals give us the tools to anticipate where the market is likely headed, allowing us to look beyond what has already happened. By understanding these drivers, we can position ourselves proactively for future opportunities rather than simply reacting to past price movements. This shift in perspective helps us stay one step ahead, trading with insights and intention. As professional traders, we always need to ask ourselves the right questions to make informed decisions. Each question addresses a specific aspect of the market, and the answers are found through the appropriate tools, our indicators. It's important to note that each indicator is designed for a specific purpose, just like tools in a toolbox. A hammer is perfect for driving nails, and a screwdriver is ideal for turning screws. Neither tool is superior, they simply serve different applications. The same principle applies to trading indicators. Here are the key questions we must ask and the indicators that provide the answers. Which type of market am I operating in? Finite or infinite? This is the first and most fundamental question because it determines the characteristics of the market. In finite markets, like commodities, supply is limited and price often react to changes in positioning and valuation. In infinite markets, like stocks, most cryptocurrencies and indices, supply is effectively unlimited and price is influenced more by macroeconomic forces and sentiment. Identifying the market type lays the groundwork for the tools we use. The forex market deserves a special mention here. Though it is technically classified as an infinite market, since you can literally create endless amounts of money, we treat it like a finite market when it comes to the application of our indicators. What kind of bias should I have? Once we know the type of market, we can determine which tools to use to establish our bias. In finite markets and for major currencies, we use the commitment of traders, COT, report as the primary tool, focusing on the positioning of market participants with valuation as a secondary measure. In infinite markets, we prioritize valuation as it helps us identify when an asset is over or undervalued, shaping our trading bias accordingly. When and for how long is this bias most likely present? Timing is everything. To determine high probability bullish or bearish periods, we use seasonality. This tool reveals recurring patterns tied to specific times of the year, helping us identify when our trading bias is most likely to align with market movements. Where should I enter and exit a trade? Finally, execution matters. To decide where to enter and exit, we turn to supply and demand. These levels provide clear, objective points for timing the market, maximizing reward while minimizing risk. By asking and answering these questions, we ensure that every trade is grounded in strategy. Remember, it's not about which indicator is better. It's about using the right tool for the right question. Let's take a closer look at how each of these tools work in practice. Let's take a closer look at our fundamental indicators and how they help us gain an edge in the market. COT, the Commitment of Traders report. This powerful tool allows us to track the positioning of major market participants, often referred to as the smart money. By analyzing their actions, we can align ourselves with those who typically have the deepest insights into market dynamics. Valuation, cross-market conditions. Valuation helps us understand whether a market is undervalued, overvalued, or neutral by analyzing its relationship to other markets or historical norms. This gives us a clear objective measure of where opportunities or risks may exist. Seasonality, dominant time periods. Seasonality uncovers recurring patterns and highlights dominant seasonal time periods. These insights allow us to anticipate when bullish or bearish trends are most likely to occur based on historical data. Each of these indicators provides a unique perspective, allowing us to navigate the markets with greater clarity and confidence. In the next lesson, we'll take a deep dive into the Commitment of Traders COT report, how it works, what it reveals, and how you can use it to follow the smart money and sharpen your trading decisions. I'll see you in the next lesson.